I don't know, that was a nice rebound that we got today. Completely, pretty much more than completely, slightly more. Reversing the move that we had on Monday. So nice jump. We didn't build on yesterday's move. We haven't really broken out to the upside either. It's basically just an up, down that we've been having really essentially for the last couple of weeks. So I'm going to kind of take a look at how these indicators are looking. There is one indicator, one chart that we look at quite a bit that still is kind of suggesting we may not be out of the woods yet. Our trade idea, however, will be looking at a stock that could very well lead us out of the woods with the move that it's making. We'll talk about how to trade that at the end of the video with our trade idea. Remember, we always put that trade on before the market closes during the Market Outlook Live, so make sure you check that out there if you're a Market Scholars subscriber. But you can see the difference, right? It looks like we may be leaning towards, a very low breadth, low volume, very boring, grinding move to the upside. That's kind of what we're at. But again, there is an indicator or two that may be suggesting, hold off on completely going all board on that train. As we saw yesterday and Friday, we could very well make the same move we made today, just to the reverse, to the downside tomorrow, and still be stuck into this range. Obviously, we'll take a look at the market forecast and other indicators that are they're looking much better. That are showing again that we may be avoiding, and we'll see that as well in the sector rotation. With what has performed well today, it is the area of the market that we want to perform well on a market move to the upside. So we'll break all that down, like I said, with our trade idea at the end, which may be our market leader on any upside move. So let's go ahead and get started. Today is Tuesday, October the 8th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website, check out some of these other things over here on the right, including our Market Outlook Live video. This is where we take a look at all our old Market Outlook trades, see whether we should stay in them or get out of them. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Scroll down to today's Market Outlook. Hit that like button there as well. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see the intermediate line still strongly bullish, turned back up. Dark green shading the green line still has been for a long time here, multiple weeks. Rebounding essentially back up to where we closed Friday, a little bit below. Well, actually, yeah, just a little bit above actually where we closed Friday, barely, like by 0.06 of a point. That of course did not keep the near-term line from dropping. It actually dropped below 60. So again, there's day one of it dropping below 60. The momentum line, of course, is not lower than the near-term line. So unlikely the near-term line will fall on day two below the 20th percentile, and form a bearish near-term low point. So more likely, in fact, we turn back up again and get back into the upper reversal zone, which is kind of what we need to see to be bullish, right? Get that near-term line up into the reversal zone coming off of this bullish near-term low. We want to form a bullish near-term high point. We are obviously still flat, still inside this range. We did not get a new 4-week high point, as you'll see here later. And we're still less than that 2.5% mark. So, again, we're not back to being strongly bullish yet, but at least we avoided a continuation of yesterday, right? So that would be our biggest issue, and we didn't have that. Looking at the NASDAQ 100, you can see something very similar. The intermediate line actually did turn up and close up above the 80th percentile. Again, back to dark green shading the green line. The near-term line, of course, is still in bullish territory, has not crossed up above. The momentum line did not get above 80 for the NASDAQ 100. Market sentiment's rising, but still, we're still above it, so that's a good sign. The near-term line, however, is still below the intermediate line, again, with it being between the reversal zones. A little bit above 80 now, but still essentially between the reversal zones until we get more of an extended run up above 80. The Dow Jones, the intermediate line, it did not go up that much, only up 1/3%. You can see its intermediate line still above the 80th percentile, but it's been on a decline to that level. And you can see, again, here, this is day one of the near-term line being below 60. Happened to get all the way below 40. Now, again, the momentum line is not below the near-term line, so it's unlikely it will drop below 20. And actually, we may be set up for the near-term line to kind of bounce back up and and form a bullish near-term low, which we hadn't done here. This was all kind of, it's now fine. This whole sideways action is finally culminating in a near-term drop below the 40th percentile. And we have a very good chance that we can just bounce right back up out of this and avoid, a bearish near-term low point that would come after this particular bearish near-term peak that we've had. Finally, we'll look at the Russell 2000. Again, its intermediate line is still falling, so we have the light pink shading. We are already below the 80th percentile. The near-term line had crossed up above, and you can see it was up the least today. The near-term line had crossed up above the intermediate line yesterday. We talked about it was unlikely it would continue, kind of like this, and it didn't, right? We dropped back down. So this is day one of it being below 60th percentile. The difference here for the Russell, because we didn't go up very much, is the momentum line is below the near-term line. Now, it's not oversold, but it is below the momentum line. So, it's not a high probability that the near-term line will drop below the 20th percentile and form a bearish near-term low following this peak. But, it is, again, we would lean more towards that probability because of where the momentum line is. Now, hopefully we avoid that, right? We still have light pink shading in the yellow line. We're essentially going sideways here on the moving average, or technically going down. That's why it's yellow. We're above a falling moving average, which makes it yellow. But you can see that we were essentially going sideways, and we haven't really broken out. We're above the moving average by 0.5%, and we haven't really gotten back up above the 2.5% mark in either direction, one way or the other. All right, let's take a look at the weekly chart for the S&P. Again, remember we were kind of in potential transition mode. Well, now we're, again, but it still is kind of a transition candle with an upper and a lower shadow. But the nice thing is we have a higher close, right? So this is a higher Hakinyashi close as of right now by about 4 points. So the more we go up, the more likely we are to continue with this higher close, the more likely we are to avoid anything too negative. It's still a small candle, so we're still not necessarily out of the woods yet there. We need to get that green line back above the purple line. But still, that's a pretty good sign that we're at least getting a higher close, if not quite getting a higher high yet on that weekly chart. Of course, the Russell 2000 is still kind of in transition mode, right? It does have a bearish candle there, and we are looking still at a falling PPO, albeit at a very high level, that PPO. Let's take a look at the 3 green arrows. Of course, we do not have 3 green arrows or 3 red arrows anywhere. We do have 2 red arrows everywhere. The S&P and the NASDAQ have a stochastics that's turned higher. So there is that. There is a green arrows there. And of course, we already have the 2. And we're that close to getting the MACD turning green to where we're back to 3 greens. Still the Dow. Remember, the Dow didn't do as well. So you still have the 2 reds. And the Russell is the closest to actually having 3 reds. And its stochastics is almost actually in. The only one, but it's almost actually into the reversal zone there, but in this case below the 25th percentile. Looking at the 2-line version of this chart, you're back above the 8-day moving average after a brief drop below, but not below the 17. The MACD is still below its moving average, so we're still in convergence mode until we can get a green arrow again on the MACD. Again, IWM. The MACD is clearly below its moving average, is almost negative. Stochastics is in negative territory, and again we are slightly below the 17-day for the second straight day, but again only slightly below. So I wouldn't necessarily say that we are now in a declining mode here on the Russell 2000. Take a look at some of these other oscillators. The DMI again is not very positive yet. We need to get that positive line back up above 25. Considering the negative is already still so low, below the 15 level. So that's kind of what we need to see there. IWM, remember, still has a more bearish pattern on its oscillator You see its ADX is actually almost below 10 again after you kind of saw that over here when we went so far sideways. Both of its lines are below 25 and they're sitting right on top of each other, actually closer to 20 right now than they are 25. Looking at the RSI and the CCI, you're back above 60, but about as barely as you can be there. The CCI is still in the upper half of the chart, so there's still that quasi semi bullish level. It's not very strong, but at least weak. Again, I'll take weak bullish versus anything bearish right now. So that's a good sign. And then looking at your Ichimoku cloud, we still have an intermediate strength trend on the S&P 500, and we're back above the green line. We're still above the cloud. We're still above the point of the rate of change is still positive. So those are all very good signs. We're not above the upper band, but we are at least in the upper quartile of the bandwidth. That's really falling. Has now fallen inside of the Keltner channel, so we have the red dots. And of course, we are not outside of the Keltner channel. We're not even close to the Keltner channel either. So again, we're quasi bullish, very weak bullish. We are definitely not breaking out here, but at least it's better than being, like I said, anything bearish at all. So we're not in the lower half of this bandwidth. We're not losing momentum to where it's shifting to the downside. So at least we have all of that working in our favor. Looking at the 4-week range, you can see we jumped back up into the top of last week's range. We still don't have a new 4-week high point yet, which actually we did not get last week. It was a week before. So we are still kind of in this mode. I would like to see a new 4-week high point, and we're close to it, to get a new 100 level in the Arun and kind of restart the clock for a potential bearish move. Because remember that this low point is going to be moving up very quickly. You can see it hasn't really dropped yet. But that 6% level is going to drop sharply tomorrow, because we're going to get a big move up, and then on Thursday, and then again on Friday, another smaller move up on Friday. So again, the range is really going to tighten up by the end of the week if we don't get a nice breakout move to the upside to expand the range back up. Otherwise, this is going to fall way lower and again make us very susceptible. If we don't get a new, especially being this close, if we get to Friday without a new high, we will be very susceptible to a breakout by the end of the week to the downside. I am leaning more towards we'll probably end up with a breakout here to the upside and breaking out of this range by the time it's all said and done before we get to that point Friday. Looking at the average volume, again 36 million, very small range. Remember, that's a good sign to get a very small range, because we really need this ATR, normalized ATR, to get below 1% to really solidify the trend, and we're not quite there yet. The volume, you can see, is not going to get very much lower because it's already so low. So if we do get a breakout, don't expect like a big sharp move. The rate of change is not going to go up very much. Over 26 days, you can see it's still 2%. It's not going to get up here to these levels again. It's going to stay at down in this area, maybe a little bit higher, but mostly stay in this area here. And it's going to be a slow grind, but we love slow grinds because that's how bull markets are. That's how bull markets don't start that way, but that's how they are maintained. Very slow, very grinding, very small moves. All right, now let's finally take a look at the volatility index. So we'll take a look at the VIX here relative to the VIX 3M. It's still above 20, so we're not out of the woods yet. We're still close to 100%, so we're not out of the woods yet there either. We need to get back below 95 and then 90 to be bullish on the markets. And we're still easily above 110. So, as I show you with the skew here later, there still is a lot of pent-up concern about the market. So, we've avoided building on yesterday's decline, but we haven't broken back out to a clear bullish sentiment on the markets. We still have, a lot of concern, and you see that on both of these charts. There's still a lot of concern about what the markets are doing going into the CPI report later this week, and then ultimately into the election would be the next earnings season that will start with the banks by the end of this week. And then after that earnings season, of course, the biggest macro event with the presidential election. So a lot of pent-up concern about that. So we will continue to be susceptible with the VVIX above 110 to a big jump higher in the VIX. and it's considering it's already above or at least near 100 and above 20, a big jump higher would be very uncomfortable for a lot of people. All right, now let's take a look at what's driving our price action today. So we'll take a look at the asset class comparison, and we'll look at just today's move first, and then we'll put it in the context of yesterday's move and see how much we reversed of yesterday. So here's today's move. The Qs are the only asset class outperforming SPY. U.S. stocks outpacing pretty much everything else. Bonds, commodities, emerging markets. Emerging markets, of course, really dropping with the news that China is not going to be stimulating with fiscal stimulus. So their commodities and emerging markets dropped like a rock. Gold also dropped, kind of linked there to commodities. The dollar was relatively flat. You can even barely see it there, but it ended up flat on the day. Bonds ended up flat on the day, so they didn't really jump up or down very much. It was basically just a reversal of what happened in China, and then, of course, the benefit that the Qs had to that with risk appetite rallying up in a very narrow way. So if I were to zoom out to yesterday to see, okay, how we've done this week so far, again, the dollar is flat. The Qs, again, rallied from being the biggest loser yesterday to now the biggest winner today. Emerging markets, the biggest winner yesterday to the biggest loser today, and down now 2% on the week. And then commodities went from being up 1.5% on the week to being down 1% on the week. So, and that's off the lows. We were at one point down 1.75%. So you can see how things change. Bonds are still, bonds were up a little bit. We're kind of flat today. Again, yields are still holding up. That's the really important thing we watch. Still above 4% at 4.03, well above these moving averages. Very strong MACD in the 87th percentile of the past year, which is actually going to improve slightly because we're going to get rid of this big number here. And the stochastics is pretty high. So yields are on a very strong move, and you notice we did not get a big change when it came to how yields are moving. If we take a look again at some of these other important asset classes that we've been watching very closely, the other asset class that didn't move very much was the dollar, and you can see the dollar staying relatively weak and still bullish, right? Still well above moving averages. The histogram pulling down, but that histogram is so big and that MACD is so high that it can go into convergence mode for a while and still be pretty bullish. So that's a good sign. The big mover of those three, of that three-headed monster, of course, was commodities, and you can see commodities big drop today. Closed above the 8-day moving average. So after that intraday rally that I showed you, but then again, that MACD is so high, so it's not surprising we're getting, a little bit of weakness here. But again, we're still very bullish. The 95th percent. I mean, this is over the last 2 years. You can see we kind of had a very similar move to get above the 200-day moving average. We kind of stayed around there for a while before making another run higher. This would be last August into September, when we had that pullback, and August, September there. So kind of very similar move we're getting right now, where we're getting above the moving average with a very strong rally, very strong momentum. The momentum turned negative, but we still kind of stayed around that 200-day moving average. And then we had a new leg higher, which is kind of what I'm expecting here to come out of these. Again, the breadth ended up being very poor. The McClellan oscillator still below that important minus 35 level. Again, anything above 35 or below minus 35 is kind of trending levels. We are back below 1,000 now. As I told you, when we get above 1,000, you usually come back down with negative breadth. We have done that. We obviously are not anywhere concerned about the Hindenburg omen yet, even though we have 2/3 of it. The one area that we're not getting continues to be the new lows. So the new lows is still very low. If you take a look at the new lows here, still right around that moving average is really low. In fact, it's getting about to where it was over here last year when we had the big broadening the trade, and then we really focused on the mega caps throughout the rest of the beginning of this year on the rest of that move. The problem is not only has new lows stayed low, but now new highs have really dropped down. In fact, it's still below 100, right? As of right now, going into the close, we're still below that important 100 level. So that's a really big drop, and that typically suggests that we're running out of gas going into this peak. It's especially considering how high the average got. I mean, this has been a while since the high got this It's about as high as it got over here in 2018. It's about as high as it got here in 2016. Of course, we got a little bit higher with that one, a couple surges there in 2021. But as you can see, once you start to break down, even though you might be bullish for a while, that usually leads into the breakdowns, and that you see these pullbacks / corrections. You also take a look at the new highs and new lows. Again, yesterday we were at 107. So again, right around that, well below the average still, right around that important 100 level. The skew we kind of watch to see about how things are looking. We did drop back below 160, but we're still above the 150 level easily. And then today you can see we're also going to be above the 150 level easily. And that's, remember, 150 is the extreme, and we've been above that for a while, and we actually hit 160, which is even more extreme here. And the average itself still right around 156, which is a very high level. Again, a drop in the skew, especially below that average, would typically coincide with increased volatility in the markets. And so that's kind of something to kind of keep an eye on. If I take a look at how the sectors are performing, the sector rotation here, again, not surprising when you have very weak breadth, you'll see kind of what the big winner today was. And that's kind of what I've been trying to tell everybody. When the markets go up, so you can see that technology is the biggest loser over the last 3 months on a relative basis, but only because when the markets go down, it loses the most. When the market goes up, as we see today, 1%, XLK goes up the most, and that's how it always is. So anytime the markets go up, it will be led higher more than likely by technology. That's one of the only two sectors, technology and discretionary, one of the only sectors outperforming the markets here. But yeah, that's what we're seeing. We're seeing continuation of this increase of this breakout here of QQQ versus IWM. You can see the correlations increasing to a positive level, or to even stronger positive level. The PPO is turning, the long-term PPO is turning up. So it seems to be we're getting a little bit of a renewal into XLK. Nice little breakout there. The highest close that we've had here in a while since this day right there. Pretty good move. Again, we need to get it, break out of this kind of bearish range on these oscillators. You can see the PPO starting to turn up. That long-term PPO has also turned positive. We have a relatively strong CCI. We're still pretty flat on some of these others. So we haven't, get back above this 200-day moving average, and we can really get going. But even just getting above the that 50-day average, as I'll show you here on this chart, that's an important level as getting above that line, turning it back higher. Where both of these, the relative strength here are both in the leading. So we're in the leading category with technology, communication services. Discretionary is weakening, but at least it's still on this side it still has the best relative strength. So it's still the furthest to the right out of all these other sectors, even if it has been losing relative strength. That just kind of goes to show where it was at. And energy is still climbing to the upside, though energy was not, one of your big winners. In fact, it was the biggest loser today. So again, to put this in context of the last 2 days, again, look at technology. You're one of the only sectors leading the markets, technology and healthcare for that matter. But you can see utilities and energy really lagging. And that's a really bullish pattern to see technology outpacing by that much, and utilities and energy both underperforming by that much. So, the sector rotation appeared, even though the breadth is very poor, so that kind of move doesn't really last very long. But again, that doesn't matter how long it lasts. As long as it's going in that direction, which it appears to be, then we'll take NVIDIA and a few other stocks being the big reasons why we're leading the way higher. As you can see, again, going back over here, the other thing we like to look at here is NVIDIA just by itself relative to the XLK. You can see NVIDIA there versus SPY is moving up, but let's look at it again relative to XLK down here. And you can see the big change, right? Well above, starting to break out a little bit in the leading category versus XLK, with both lines moving higher there, the momentum and the relative strength. Whoops, let's do it versus XLK. And you can see again here a nice little breakout move on the ratio chart, again getting above these highs. The MACD is turning positive. The long-term PPO is turning positive. Very strong move on some of these oscillators, on the DMI, on the CCI, on the RSI, all very strong moves, suggesting this might be a little bit of a breakout move. And again, low breath moves, might not be like long-term runs, but we'll take it as long as it lasts, right? And hopefully it can continue to carry this current intermediate run just a little bit longer and into potentially into the election, kind of get us through the CPI report that's supposed to be pretty weak this week, and ultimately into the election and the next FOMC meeting. Which, with those rising yields, again, that's going to be the factor. But as of right now, again, the 2-year yield was down a little bit today, but remember that yield spread is dropping again, right? It's up 4 basis points, but you can see it's dropping. And like I said, markets love a falling yield spread. And if it falls back below 0, markets love a negative yield spread. So we want it to get that way. You can see it's been negative this whole time, and the markets have been bullish this whole time. So the markets want a negative yield spread and the falling yield. We do not want it to be rising. So that's a very, very good sign. This is the one that's really not moving very much, as it has risen, but it's not falling back down because that 3-month, which currently is priced in one cut at the November meeting, even with a little bit of a rally here, pretty much still is pricing in that one cut. So that next cut here in November is still pretty much priced into an 86% rate, and you can see in December we pretty much have an 88% chance of another cut in December. So those two are the two I'm still banking on. After that, I think as we get to the end of the year and we get some more CPI and employment numbers, I think the Fed will start to backtrack off of, and we'll get those December projections. We'll start to backtrack off of all the cuts they've projected into next year. And we'll be able to get, again, with those cuts coming off the table, we'll be able to get this curve to come back down with the 10-year yield rising. Right, with this rising, we'll get this curve back down, and that's exactly what we want to see to have a bullish 2025. All right, now let's take a look at our trade idea of the day. We'll take a look at NVIDIA here. As you can see, NVIDIA has been leading the market's charge today, and really had a really good day yesterday too. And it's also kind of the reason why the breadth has been so bad, as we talked about. But you can see the intermediate lines turning up. It's up. It has been in bullish territory, but now it's closely getting back into the reversal zone. Good bullish near-term peak. We're 13% above the 30-day moving average, which is green now. So we got dark green shading the green line. But again, you can see that that's not the extreme. So which is about twice as big as that. So we're still okay there. There's still room for it to grow. If you take a look at the weekly chart, you can see this week's candle. The PPO has been coming down. It's turning back up a little bit. Good bullish candle here after a few transition candles that never really did get back below the 10-week moving average. So that's a good move to the upside. If you take a look here at the 3 green arrow chart, we obviously have 3 green arrows and close to average volume. You can see the move away above all these highs, these recent highs that NVIDIA has had. Taking a look at the 2-line version of this chart, you can see, we're still above the value area, the 1 year, well above the value area, still above all these moving averages. The MACD and stochastics are bullish, where the 8 and 17 day is now starting to move away from the 30, kind of like, it did not do during this bullish run, but now it is. And partly is because now we're starting to get kind of these breakout patterns. The DMI is broken out above 30 on the positive indicator, below 20 on the negative. The ADX is just starting to turn up, hasn't crossed below 20 yet, so there's room for that to grow. You can see the RSI and the CCI. The RSI has broken up above 60 for the first time in a while, or to its highest level for the first time in a while. And CCI has also broken up to its highest level, almost at 200. That's a good breakout pattern there. Looking at the Ichimoku cloud, you can see we're already above the cloud, but we're just getting above it. The rate of change has now turned strongly positive over the last 26 days. We have an intermediate strength trend that looks to be developing into something more. This is the highest level this trend quality has been in a while. So that's a good sign. And then the best sign out of all of these is the break above both the upper Bollinger Band here with the bandwidth falling, but we've broken well above the upper band and above the upper Keltner channel. The bands themselves are still inside the Keltner channels, but again, a break up above those would suggest that we can kind of break out like this move here and get going here for a while, kind of like we did right there. So that's kind of the hope, right? The idea behind this this trade idea. So we'll come over here. I decided to go to the low. Remember, we've already put this trade on during the Market Outlook Live. I went to the low 20s delta and sold that strike, bought the 150 for a $2 wide spread. Position size normally for that normal $500 of risk, and getting almost a 4-to-1 with very little flexibility. So, and I don't think we necessarily need a whole lot of flexibility on this anyway, considering all the breakout patterns we're getting here today. So there's our trade idea for the day. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.